Back in 2008, the entire global economy was staring into the abyss. I mean, we were on the verge of a complete meltdown, something we hadn't seen since the 1930s. And this financial earthquake, it didn't start in some high-tech boardroom. It started with something way more personal.
It all kicked off with the American dream itself. You know the one, owning your own home. For decades, that was it. That was the goal. Built on hard work, saving up, sound finances. But in the early 2000s, something started to twist. That dream began to warp into something else entirely.
And this simple, wholesome dream? Well, it turned into an absolute global nightmare, one that cost millions of people their jobs, their homes, and their life savings. So the question is, how on earth did a housing boom turn into a bust that nearly brought the whole world to its knees? Let's get into it.
Okay, so picture this. It's the early 2000s. The dot-com bubble has just burst, leaving a huge hole in the economy. And then the 9/11 attacks happen, and consumer confidence just plummets. The government knew it had to do something, and fast, to get money moving again. And they had one really big lever to pull. And that lever was interest rates. The Federal Reserve, that's America's central bank, started slashing rates like there was no tomorrow. I mean, they went from over 6% all the way down to a rock-bottom, historic low of just 1%. All of a sudden, money was just incredibly cheap to borrow. The whole system was flooded with it. Now, all this cheap money created a massive problem for the big players. We're talking pension funds, global banks, you name it. Their usual safe bets, like government bonds, were now paying out next to nothing. So these huge investors were absolutely starving for better returns, and they started desperately looking for a new, safe, but profitable place to park trillions of dollars. And where did they find it? The U.S. housing market. Right. And this is where Wall Street comes into the picture. They saw this massive hunger for returns from investors on one side and this flood of cheap money on the other. And they thought, aha. They basically performed what looked like financial magic, promising to turn simple, boring home loans into investment gold. Their first trick was something called a mortgage-backed security, or an MBS. On the surface, the idea was pretty simple. Instead of an investor buying just one person's mortgage, which is a huge hassle, a bank would go out, buy up thousands of them, bundle them all together into one big package, and then sell little slices of that package to investors. So here's how the machine worked. A local bank makes a loan to a homeowner. They immediately sell that loan to a big Wall Street bank. Wall Street bundles it into one of these MBS products and then sells it off to a big investor. The investor gets a nice steady stream of income from all those homeowners' monthly payments, which was way better than what they could get from bonds. It looked like a win-win for everybody. But Wall Street wasn't finished cooking. They took these MBSs, chopped them up into different pieces, and then bundled those pieces with other kinds of debt to create something even more complex, even more risky: the collateralized debt obligation, or CDO. This was financial alchemy, you know? They were taking riskier and riskier loans and magically transforming them into what they claimed were super safe investments. So you're probably asking, how did these incredibly risky things seem so safe? Well, the credit rating agencies, the supposed independent watchdogs of finance, were slapping AAA ratings, the highest possible score on them. But here's the catch. These agencies were being paid millions of dollars by the very banks whose products they were rating. It's kind of like a restaurant getting to pay its own health inspector to give it a good grade. What could go wrong? So this Wall Street machine created a monster, an absolutely insatiable demand for more and more mortgages to feed it. And that demand set off a full-blown gold rush in the housing market. It was a complete frenzy, fueled by easy money and the total abandonment of pretty much every old rule in the book. Traditional lending standards? Yeah, those got tossed right out the window. The new hot thing was the subprime mortgage. And the most infamous example was the ninja loan. That stands for no income, no job, and no assets. Seriously, if you could breathe, you could get a mortgage. Lenders were just handing out money without even checking if people could actually afford to pay it back. And when you throw all of this easy money at the housing market, well, you get a pretty predictable result. Prices went through the roof. And this wasn't a steady climb. It was a bubble inflating at a totally insane and unsustainable pace. People started buying houses not even to live in them, but just to flip them like pancakes, because everyone was convinced that prices would just go up forever. So why was everybody acting so reckless? Because the entire system was built on really messed up incentives. Think about it. The mortgage broker on the street, They got a commission for every single loan they made, whether it was good or bad. They didn't care because they just sold the loan to a big bank. The big bank didn't care about the quality either because they just bundled it up and sold it to an investor. Everybody thought they were passing the risk up the line. Nobody thought they'd be the one left holding the bag, or so they thought. The whole thing was basically a giant Jenga tower built out of bad debt and a whole lot of wishful thinking. And then in 2007, somebody finally pulled the wrong block. Those subprime loans, many with adjustable rates that suddenly shot sky high, they started to fail. Homeowners started defaulting, and the whole tower began to wobble. And then, in 2008, it all came crashing down. The dominoes fell so fast, it was terrifying. In March, the huge investment bank, Bear Stearns, just imploded. By September, the government had to take over the mortgage giants Fannie Mae and Freddie Mac. And then came the moment nobody thought could happen. Lehman Brothers, a 158-year-old pillar of Wall Street, went bankrupt. The very next day, the insurance giant AIG needed a colossal bailout just to keep the lights on. And just like that, overnight, the lifeblood of the entire global economy, credit, it just stopped. It froze solid. Banks, absolutely terrified about who might fail next, just stopped lending money to anyone, including each other. It was like someone walked over and yanked the power cord on the entire financial system. This quote from Warren Buffett, it just perfectly captures that moment. Nobody knew how bad things really were. Nobody knew which banks were holding all the toxic junk or who was about to go under. It was this thick fog of pure panic. And in that chaos, the people in charge knew they had to act, and act fast, even without knowing everything. Because if they waited, they risked losing everything. The collapse on Wall Street sent massive shockwaves through the real economy, the one where we all live and work. It triggered the worst economic downturn since the Great Depression. We call it the Great Recession, and honestly, its legacy is something we're still dealing with today. So, facing a total collapse, the U.S. government took some truly unprecedented steps. It launched the $700 billion TARP program to bail out the banks that were considered too big to fail. It passed a massive stimulus package to try and jumpstart the economy. And a couple of years later, it passed the Dodd-Frank law to try and reform the whole financial system and prevent this from ever happening again. But the damage was already done. And the human cost, it was just staggering. 8 million jobs gone. 4 million families lost their homes to foreclosure. And get this, $19 trillion in household wealth just vanished. This wasn't just a Wall Street problem, this was a Main Street catastrophe. You know, all of this left a really deep and ugly scar on the public. While millions of ordinary people lost absolutely everything, not a single major bank CEO went to jail. The people who lit the fire walked away with millions, while taxpayers got stuck with the bill. It was a bitter lesson. The system was set up to privatize the profits for a few, but socialize the losses for everyone else. So in the end, yeah, the government's actions did manage to pull the economy back from the brink of another Great Depression. The system was saved, patched back together, but it leaves us with this huge, lingering question. The banks were saved, the economy eventually recovered, but was the public's trust in the very institutions that are supposed to build our future, was that trust lost for good?